Hi everyone, my name is Mark. I'm a CPA and accounting tutor, and today I want to talk about owner's equity. So owner's equity can be something that's kind of hard to understand for a brand new accounting student, but I think it's easiest to explain through the basic accounting formula, which is assets equals liabilities plus equity. That's usually the first thing every accounting student is taught. Okay, so let's talk about what assets are first, and then we'll get to equity. Assets are anything that a company owns or anything that is owed to that company. So for example, a company's cash, maybe a building that it has, its supplies and materials, those are all assets. And then also, if somebody owes that company money, that's also an asset for the company. So say they made a sale but didn't get paid yet, that money that they're going to receive in the future, that's considered an asset, that's accounts receivable. A liability is something that a company owes to somebody else. So say a company takes a loan for $10,000 from the bank. That $10,000 is going to be a liability because they owe it back in the future. And then equity, which is what we're talking about today, is going to be everything else. So when you think about it, equity is anything that a company owns, any assets that it doesn't owe back to anyone that aren't liabilities, right? So it's the half that aren't liabilities. So for example, if a company has $10,000 in cash and no other assets, but it doesn't owe any money to anybody, that $10,000 is going to be all equity. It's completely equity because it doesn't have any liabilities. So there's actually two ways that a company can get equity. One is paid in capital. That's, for instance, say you start a company brand new and you give $5,000 to that company. You don't expect it back. You're just giving that money to the company so you can get started. That's going to be owner's equity, $5,000 in owner's equity. It's going to be cash, $5,000, and equity, $5,000. That belongs to the company. It earned it. It gets to keep it and doesn't owe it back. So a good example of that also is when a company sells its stock. So if a company sells $20,000 in stock to a stock owner, they don't owe that money back ever. That they get to keep that money. So that's going to be equity. They're going to have $20,000 in equity. Another way a company can get owner's equity, other than paid in capital, is retained earnings, which basically just means the company earned it. So if they make $100 in profit from sales, that's actually going to be equity. They don't owe that money to anybody. They earned it through their sales, so they get to keep it. They own that now, and that's what's considered equity. So let's walk through a couple journal entries to maybe increase your understanding of owner's equity. Say a company buys a building for $100,000 in cash. They're going to debit the building for $100,000, and they're going to credit cash for $100,000. Well, building is an asset, so that went up by $100,000. They got a new building, and they paid in cash, which is also an asset. So an asset went down by $100,000. So you'll see that assets goes up and then goes back down. So that doesn't affect equity at all. Equity stays the same. It's exactly where it was when we started. However, let's do another situation where you start a new company, and say you give a building to that company. So you want to use this company, you're not going to use it for your house or anything, you're going to use it just for your business. So we would debit building, $100,000, we'll assume that's the value, and we're going to credit owner's equity for $100,000. That building didn't cost anything for the company, they got it, it was given to them. So that's going to be all equity. It owns it now. It doesn't owe it back ever. So as another example, let's say the company sells its stock, right? So a stock owner buys $10,000 in stock from the company. They pay the company in cash $10,000 for that stock. So we're going to debit cash for the company. And then we want to credit common stock for $10,000, because when you sell stock, you want to credit it. So that common stock is part of owner's equity. So we're increasing equity when we sell that stock, and we're going to increase it by $10,000. So that's another example. And then we can also split it sometimes between liabilities and equity. So let's say a business needs a new building, and the owner says, okay, I'll pay for half of it through with my own personal money, but I only have $5,000 to give. Excuse me, $50,000 to give. And the company doesn't know how it's going to get that other $50,000, so it takes out a loan. Well, they're gonna take out that loan and get that building for $100,000. So they're gonna debit building for $100,000. They're gonna put that loan as a liability for $50,000, and then they're also gonna credit owner's equity because the other half was paid for by just an owner. $50,000. So in that case, they have a brand new $100,000 asset. They have a $50,000 loan liability, and then the other $50,000 that was just kind of given to them is equity. So to recap, there's two different ways to get equity: paid in capital and retained earnings. And then equity can be considered anything that a company owns but doesn't owe back to anyone. All right, thanks guys. If you have any questions, feel free to shoot them over to me. I'd be happy to help out. Bye.